Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. A couple of past guests I always love to mention: Mike Bosch from Atento Capital, Chip Gavarino from Topeka Coffee. We had Lee Easton on from Arrow Vision a while back, talking about entrepreneurships and some of the grit that is required to make a business work, pivot, and think through different options once you've already started your business. But maybe some things don't work, and you've got to make a little change. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we're a full-service property management company, helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Listen, Brooke, you know, you're actually an existing client of ours, and we love you for that. But
Yes.
A lot of the stuff we do is like taking properties from the tax auction, doing a full renovation. I recently bought one at the tax auction on Woodrow, and I walked it the next day with Seth, our general contractor. He's now been in 3 weeks of renovation. We're doing new plumbing, new electrical, new HVAC, new roof, and new interior, taking down some walls, putting up some other stuff to make it awesome. And that's what we do for our clients as well. I am like that hair guy. I'm not just the owner. I'm also a client, and I love it. I used to do this work myself. Now I don't do it myself anymore. We've got Seth Rice on our team, who's such an awesome general contractor that we do it. That's why it doesn't matter what type of rental you have, single family homes, condos, townhomes, apartments. We have the management solutions you need. Go to keyrenterpmc.com or info@keyrenterpmc.com. Brooke, I was originally introduced to you through Keyrenter. Actually, Lisa Goins put us in touch some time ago. We've had a chance to chat extensively, but let me introduce you quickly. You are, as I said, not only a client and investor, you're the husband of a beautiful Italian named Amy. Love that little international flair. Father of three brilliantly gifted young people: Jordan, who's married to Addie; Kara, who's married to Eli; and Emily. You're also a longtime residential real estate investor that's seen it all. You've been in this for like 30 years. Is that right?
Yeah. I mean, really 25, I stopped counting. So somewhere above that.
Since you were two.
That's right. Exactly. Since I was two.
Brooks focuses on owner financing by offering his tenants ownership through a contract for deed. We're going to get into contract for deed. We're going to get into some lease to own. Brooks' day job is in corporate finance, but he's got a strong passion for hard assets and a specific focus on real estate, though he likes gold and some other fun stuff that we can dig into. There are a bunch of ways to do owner finance deals, and there's certainly a dark side where investors are hoping that their tenants don't pay off the note and an investor can take back the property to sell it again. Brooks not one of those guys. He's going to talk about some of the success stories that he's had over the last 25 plus years in investing, and certainly some of the failures or some of the mistakes that he's made. We've all had them. It's good to highlight them so that other people don't do it. And today we're also going to talk about some of the mistakes and the victories, but also his passion for mentoring and teaching, which is a big deal to Brooke. Brooke, welcome. So happy to have you.
Yeah. Thanks for having me, Matt. Love it.
Tell me kind of broadly, how did this all start? How did you get started so long ago doing contract for deed work?
Yeah. Well, I come from a family of teachers. My dad's a pastor, retired. So, I grew up in a wonderful family, but there was no business mind. So all I knew growing up was, teacher, policeman, fireman, like that's it. Right?
W-2.
So I was, mid 90s, I'm married, had my first kid, and I got to restart. So I actually went to the University of Tulsa and did an MBA.
Cool.
And which is rare for a guitar player guy like me, right? So, I was kind of a little older and thought, wow, this is fascinating. So I did the old, 5-year plan of really learning how the world works economically. I wanted diverse opinions. I wanted to be challenged. So while I was working on the MBA in the late 90s, I did my classic read Napoleon Hill, Think and Grow Rich, Rich Dad, Poor Dad, The Richest Man in Babylon, reading. That's how we learn. And I kind of, wow. Now I drive around, I see houses, real estate. I'm learning, hedge funds, private money, retirement accounts. Where do they go? How do they invest? How does this work? So because I really had no mentors in my life along these lines, I felt like I had to really break some eggs, to make an omelet. So I I launched out on my own while finishing up the MBA, bought a fourplex and ITU, bought a duplex in 99. So I started out having no clue what to do and just did strict rentals. But with the that was the tech bust 2000. There's a lot there. WorldCom, Enron, tech bust, 9/11. There's a lot there. So,
tumultuous period. So you went from the fourplex, and did that? First of all, I have to say that the area by TU that's grown so much. It's gotten so much nicer. Do you still own that property or no?
I do not. I sold it. Yeah, probably 2006 or 7.
And so, how did you transition from just the standard rental management game into the contract for deed game?
Sure. Probably pain is our biggest educator. So I moved really fast into being a broker for myself, my own office, probably too quick, which that would be a mistake we talk about. But so when 2008 came along, I was buying the heck out of houses in Tulsa. And I had a really solid rental portfolio for someone that started from scratch with no money.
Yeah.
And the banking crisis caused the equity squeeze pretty aggressively. So really what I struggled with is liquidity. And I did not bankrupt. I did not go out of business. I looked very closely at how to make this work, but I had to get into a day job to make up the difference.
Right.
What I did is I took the long play and got into corporate finance, but I took all of these assets and I was experimenting in the community that I'm in, especially in East Tulsa. And it's fair to say that there's a big Hispanic community over there. Mm-hmm. What I discovered was people kept asking me, do you sell your houses or could you do owner financing? So there was really, Matt, like years of experimenting. So I remember someone teaching about a lease option in probably 2008 and 9 when I was in kind of a desperate place. Sure. And here's $3,000 and and a $900 a month payment, and it's a lease option. And I thought, well, that's interesting. So I started doing some of them for some down payments. Mm-hmm. The truth is, I went pretty hardcore because I like to hang out with accountants and lawyers and title attorneys and really get into the details. So I've paid a lot to learn some technical aspects of this. I transitioned after a few years into a straight contract for deed. And so I would imagine some of your clients, and the reason we're talking is the difference between lease option.
Right.
In California, they might call it a land contract or a true contract for deed. And the reason I did this whole thing is it solidified my cash flow. So I no longer had the midnight famous, toilet exploding call during Christmas. And that's what I needed at that time because I was struggling with liquidity. So I took these assets and I slowly transitioned them into selling them and then solidifying the cash flow, much like a REIT, if you know what I'm saying. So I became interest income focused rather than rental income focused.
Interesting. So let's talk about the difference then between lease to own or a rent to own contract and a contract for deed. What you're saying is you solidified your cash flow, which means you're now dependent on interest payments like a bank instead of on rent payments where you and the solidifying the cash flow portion is where you don't have to come out for a new HVAC system or you don't have to come out for a new toilet, a plumber that's handling plumbing lines. So explain the difference then between or why you in one scenario do have to pay for things, in another scenario you don't have to pay for things, and the benefits and drawbacks of both a contract for deed on one hand and a lease to own on another.
Sure. I discovered in the market, especially in the Hispanic community, there was a lot of abuse with the idea of rent to own. And there is never a more vague phrase than rent to own because it needs to be specified. So to get technical, an option in the finance world is, I'm buying the rights to do something. I'm buying an option to buy a stock at this price in the future or to sell it at this price. So, a hedge, if you will. So in real estate, someone could buy the option to buy a piece of real estate or a house in the future at a certain price. So if you're doing a lease option, it's not mortgage law. It's just a rental. I mean, legally speaking, and I've experienced this by being in front of judges. Right. That'll teach you, right?
It will, for sure.
Judge, and I tried to evict somebody in a contract for deed situation.
And they said, you're in the wrong court.
No, you need to go down the street and do, you're foreclosing. You got to foreclose.
Correct.
So in a lease option situation, I'll just give a scenario. They're gonna rent this house for $1,000 a month, and then they're gonna pay $3,000 down, and it's an option fee, and it's gone. It doesn't get returned back to them. They've bought the right to buy this house at a pre-established time in the future. So that's the quick answer to.
But it's still a lease in essence.
It is still a lease. I can a forcible entry and detainer.
Got it.
Have to follow the landlord-tenant, act, right? I have to follow state law and jurisdictions and all of that. So it's a strict lease.
Whereas a contract for deed is actually a fileable mortgage. People can do title insurance. They can run, a title search, and then they actually own the property. The deed has changed or has not changed. Actually, I guess it has changed.
So that's a great nuance, and we really need to go into all of that. And what I discovered is so many people were abused by the lease option thing that the lease option thing protects the landlord. Okay.
Right.
Doesn't really give them any power. And I realized because I wanted to move in integrity. Okay. Right. That's a problem. Sometimes integrity doesn't make you a lot of money, right?
Sure.
Did build a good name over years, right? So I went contract for deed because it gives some power to the occupant of the house.
Right.
So I can't run off, ruin my business, and just sell the house out from under them. So the way that I do it is just through years and years of mistakes, errors, clarification, and then saying, Your Honor, I hear you. I will never do that again. I will honor that, and then I'll make that happen. So I've hired some attorneys over the years to write up a contract for deed document.
Got it.
The way that we do it, I'll tell the end game, and then we can go into the nuance as you see fit. It does require some organization. So because I'm an MBA, I do get into the details of a amortization schedule. So when they make a payment to me, it is actually PITI. It's principal, interest, taxes, and insurance. So I give them an actual letter of intent contract that they sign that outlines their interest rate agreement, how taxes and insurance work. Okay. And so when they make a payment, I keep the taxes and insurance portion, which is huge, and it stays in an escrow.
Yeah.
My job with the company is I make the annual tax payment for them and the insurance payments. Okay. And then I work with our accounting firm to send off to the IRS the interest that they paid on this house. They get to write it off on their taxes. So you
send them a 1099 INT. Is that right?
I do.
Okay.
I do. Now, technically, it is an electronic document that is sent to the IRS.
Sure.
But because a lot of my clients don't have like a tax return, they'll file a return with their green card and they want to write off the taxes. One of my business contacts in East Tulsa is a tax business. So a lot of my clients have flowed through a Hispanic tax business. So in a sense, all of the taxes are done by them. So that's a huge factor. If that makes sense.
Do you want to talk? I'd love to know who that person is for anybody that may not have a social security number right now, but want to buy a house. They're able to actually, or do work. Like many of our vendors, they establish an ITIN, they establish an LLC, they pay their taxes through that LLC, and they also pay for their general liability insurance through that LLC. Yeah. But you need a CPA or a bookkeeper or somebody that knows the ins and outs of doing that to actually establish that entity for you as somebody that might be on a green card, right? Who does that work?
So Anna Marino at EMA Tax Service.
Cool.
Is really my key relationship in this business. And that does formalize feel good for her clients.
Yeah. Awesome. So just concretely then, contract for deed is you no longer own the property. You are escrowing insurance and you're escrowing property taxes, but you are in essence collecting principal and interest. There's principal reduction, then there's interest that you're being paid. That's your primary income source on that. You are not responsible for additional for maintenance. You're not bound by the Landlord Tenant Act. And if you want to if somebody stops making a payment, you either need to do a deed in lieu of foreclosure, or you actually foreclose on the property in foreclosure court, not in Landlord Tenant Act. Where
I do need to clarify, and I do need to clarify something that I know the detail-oriented ones that are interested in this will really want to know. So the thing is, they have the right to file the contract for deed if they want to. Okay, so that would be clouding the title. Okay, true title doesn't change.
Got it.
In a simplistic way of thinking, it's like a used car lot. Okay, you know how car financing happens. You pay your loan, you don't get the title to the car until you pay it off.
Right.
So a contract for deed, a land contract in California, it would be you have a contract. Once you fulfill the contract, you get
the deed. Right.
Contract for deed. So we have done it many different ways. Some of them, they want to file it and they want to feel good about that. And then it is in the courthouse. The ownership is still my company, Stonebrook Investment Group, if you look it up online, but the title is clouded. So if a title search was run, they would see that document. I would say this though, because I'm working with integrity with Anna at EMA and everything that I'm doing, it usually is I don't file anything at the courthouse. And then we involve the attorneys with closing. So the attorney has the contract for deed, the client has the contract for deed, and Stonebrook has the contract for deed. So we're all upfront with what's happening. And the reason I do that is because oftentimes after 5 or 6 years, if something happens and they say, Brooke, I went through a divorce or I need to go, and they leave, then I don't have to go through an enormous, expensive lawyer foreclosure process to clean the title. I don't have to do a quiet title suit. I don't have to go through all of that. I simply work with the accountants to clear the books on a deed in lieu of foreclosure process. And then I would resell the house based on current interest rates and where the market is.
But can't you do that also by including in the original contract for deed a quit claim deed that they can then sign to basically sign over any interest they had in the property back to you if they want to actually get out of the contract? Where you just say, we do this for apartments, for example, when we sell apartments, our attorney, Tom Vogt, who's a wonderful attorney down at Jones Gotcher, he does at the end of it, he says there's a final drop dead date. If you haven't closed by, you can have some extensions on inspections, you can have extensions for financing, but if you haven't closed by this date, the contract says you can sign this quit claim deed, which says basically in essence, you have no right or claim to this property any longer. And as long as the other person contractually, the other person on the contract signs that, then they indeed have no right to any claim on the title. Is that not a different way? Have you ever experienced doing that?
It sounds like you're describing a lease with an option, though. Like in other words, they have signed this saying if you don't close by a certain date. Well, I've already closed in a sense.
Right.
So I might say, I'm going to give an interest rate on a 20-year loan and we're locked, or whatever the deal is we put together.
Right.
Then we're just the bank and we're just collecting the payments. They can refinance it if they want to pay us off. They have done that. They can sell it right out, which is an interesting thing we can talk about. Or they can just park it and never refinance it because they don't trust banks for whatever reason and they want to pay higher interest with us and they just want to just keep going.
Right. Love it.
So I don't do the quit claim deed because it's mortgage law as it is.
Got it. Okay. So all that is contract for deed. The lease to own, on the other hand, is there's a down payment for the option to buy the property at some point in the future. You probably predetermine that price. And then they're paying every month a lease. Some portion of that goes into the equity component of the house or
it can. It's all negotiable. Okay. I've had some people do that, $50 a month or not. It's just an option and it's just straight rent.
So there's a possibility then, if that's the case, then the tenant in this case now has some equity built into the house such that when they go to refinance, if they want, they've got an equity down payment contribution already made. But still, it's governed by the Landlord Tenant Act of the state of Oklahoma. If you want to evict them, you still have the right to evict them in FED court and small claims court downtown. But you also then are responsible for the maintenance of the property. So if the HVAC system goes out, you're still responsible. And the critical difference here is that on one hand, you still take depreciation, interest, expense for the mortgage that you may have on the property, even though you've kind of leased to owned it. And then on the contract for deed side, you no longer have the right to do depreciation or anything else. You've sold the property. You no longer.
That is exactly right. That's exactly right.
So it's a big difference in your strategy, whether you want depreciation and whether you want the, depreciation comes with headache, comes with additional expense, as you call it, variability in your cash flow. Whereas contract for deed comes with no depreciation, no ownership rights, but has more stability in the cash flow because you're collecting interest in essence.
Yeah, which is why I'm here for Keyrenter, right? I manage all of the properties, the assets, the bulk financing of the finance company, right? But I don't have depreciation, which means great cash flow, good assets, liquidity.
Right.
But I don't have the tax benefits of depreciation. Right. So I'm working with Keyrenter to build up something you guys can manage. Because like we said, I value your management, your renovations, and you guys do that. And then if I buy something and want to sell it on contract for deed, that's how I spend my time on that side. So the strategy, yes, I have a little bit of a tax issue right now, and I need some depreciating assets in the future. That's why we're talking. So
that's what I'm in it for. I love the depreciation element of real estate. It's such a great, it's a non-cash component, but in the end, you're not paying the government, and that means there's actually additional cash in your pocket. Let's talk about this big mistake that you've run into. Or that you ran into in 2008, the liquidity side. What do you think? I mean, for a real estate investor that owns one property, 10 properties on either end of the spectrum, how much liquidity do you, in your experience, would you advise somebody to keep if they're in the rental game? Forget for a moment the contract for deed game, but at least to own and or just pure rental. What sort of liquidity in your experience would you recommend people have?
Wow, dry powder. Man, for 2008, and I'll give a shout out to all the old school investors in Tulsa know Sharp Mortgage. And so I don't know if George and family are, listening to this or whatever, but I remember borrowing money from him in the early 2000s, as we all used to do with, Tulsa real estate investors. And the issue was all of the above. You just never know. 2008 changed the game because, I used to have a guidance line. In 2005, I had a local bank and I had a $500,000 guidance line. I could just buy a house and they do an appraisal at 80% and they just write me a check for the 80%. That was no cash out of pocket, boom, 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 the Wild West.
Right.
The problem is I got a phone call that summer from my banker and they said, Mr. Reutter, we appreciate your business. We are pulling the line of credit, but I've got 3 properties in play. I've got to renovate them. No, we'll allow you to close, but you cannot do a draw for renovations.
Wow.
And we're shutting it down. So you're fine. Thank you for your business and your wonderful credit score. So that was a 6-figure cash bammo.
Evaporation.
Was squeezed on. So I think to answer your question, it depends on your personal situation. If you're a single guy with no overhead in an apartment,
right,
you can play a few extra games, paid off car, you get what I'm saying. But if you have overhead, family, kids, you really need to be aware of what the nut is that you've got to hit each month. So I can't really give specifics, but because of what I went through, I will tell you this. I want to be real healthy based on where we are right now, because I remember 2008 and 2009 with George Sharp telling me, Brooke, I remember the oil bust in the mid 80s. And I remember buying 10 houses at the courthouse for, between $6,000 and $7,000 each because there was an issue. So I think the liquidity problem is not just surviving day to day when the sun is shining and all is well and tenants are paying rent. I think the issue is for the next opportunity, if that makes sense.
Right.
So what I want to do is I want to be ready when things are changing for new purchases. And that's kind of where I am now. Really, really, really am. Even my accountant said, wow, Brooke, you're like more conservative than I am because I just keep a lot of cash on the side.
That's from experience. I mean, that came.
The question. I mean, I know there's some nuance there that the
depends.
Certain of us like a number, but I think, whether or not you want 50 grand or 100 grand, you need some cash on the side.
Right.
Hard time.
So I'll say two things. Dave Charney, who's a very close family friend of ours, owner of Capital Homes and a real estate investor himself in a very significant way, said that in 2008, they had all these, they take raw land, they develop it into parcels, they put in the sewage, the energy infrastructure, et cetera. And then they develop houses on, ultimately they sell their houses, but they've got capital tied up for a long period. He said in 2008, some of his banks called him and said, you've been a great client of ours, just like you. You've been a great client of ours. We're extended to you, but we're now closing these lines. And I'm sorry, you've got to figure out alternate financing. And it kicks you right in the pants. It's tough, especially when you've got a lot of deal flow in the works. So that's really tough. On the other hand, in 2020, when COVID hit, I called my banker, Josh Cole, over at Security Bank, who's been our banker for years now, since we started Keyrenter and started the property ownership business. And I said to him, Josh, I want to know, I've got a high 5-figure credit line with him that we tap into occasionally. And I said, should I pull this, put it into a different account and just pay the interest on it? Because we have tremendous uncertainty about what's going to happen with our business, with liquidity in the market, et cetera. Or should I leave it with you and you guarantee me that you're going to keep this line of credit open? Having heard these stories from Dave Charney and guys like you from 2008. And he said to me, Matt, we're a community bank here to support the community. It doesn't matter what happens with global liquidity. We're going to keep that line of credit open for you to use to support your business, because we're here. In essence, our mission is to support local businesses. And what kind of bank would we be in a community like this if we pulled your line of credit at the time that you needed it most? And I was like, wow. I mean, I love them. I've always loved them. Lynette Lambert over at Security also has done our SBA loans. She's wonderful to work with, also a client. Josh has done so much work with us. But I was floored by that response. He said, we're not taking away the line of credit. Keep it. It doesn't matter what uncertainty we're facing. You'll have access to that cash. And I went, wow, holy moly. Wow. So two sides of the same thing. I mean, '08 was arguably a much deeper, graver crisis and had a more prolonged effect than 2020, the COVID scare. But that the two sides are two looks at a similar story, honestly.
Right.
So in the selling of a contract for deed, tell us a couple of stories where people have bought out, they've refinanced and paid you off.
Yeah.
Any prepayment penalty that you normally employ, or is it just kind of, hey, thanks very much, shake the hand, and now you're off to buy another house to do it again? How does it work?
Sure. And for those that are really finance minded with this, I just also want to clarify one thing. You can do a contract for deed even if you have a loan on the property. Okay. So these are not paid off. Okay. So again, what I took is my original asset base in 08 and 09 and slowly transition them over. So what I do is I have package loans. Let's say, I'm going to talk in vague terms for the conversation. 10 homes on $1 million loan through a bank, because we have several banks locally that we work with. So if someone actually pays down, then I would say to the bank, all right, we're going to peel this property off the package loan so that way it's released. And then I would call David Dreyer, local attorney that's fabulously well known. And then I will have a closing where we will do a general warranty deed signing, and I will deed the property over to the client once they've paid the loan off. So, we've actually had that happen 3 times. And people say, oh my gosh, Brook, what do you mean? Like, people don't pay? Well, I'm here to provide a service. And if someone needs to go, it's like a used car lot, not a problem. I will take it back and then I will sell it again. And it's much more like a REIT. It's a finance. It's not one house is the problem. It's part of the package. I will take that house back, resell it. But if someone wants to stay there and pay it off, we've had one family, they've put a lot of family in that one house, and they made, triple, quadruple payments every month, really accelerated the principal. And then we had kind of a little party at the end. Good for you guys. You paid the house off and we deeded it over and it was great.
Did you have tacos and cerveza at this party?
Always. When I collect payments before I had the Dropbox, now you learn those messages. I mean, Friday at 5, Mr. Brook, hey, come on, get the payment and you got to try these asada tacos. Oh my gosh. Fridays are good.
That's a perk. That's a perk of being in the industry.
It is a perk.
I love it.
Hey, one other thing I want to throw out too. The IRS loves contract for deed. Okay. Judges love contract for deed. Okay. So mortgage law, right? Bankers don't mind it either. That my banks understand what I'm doing. No problem. Here's who doesn't like contract for deed and creates a little bit of a nuance that you have to manage. Insurance companies struggle with it. And the reason is if, you as a client come and want to buy insurance for a property that you bought in contract for deed, it might not be in your name.
Right.
And they don't care that the title is clouded. You know what I'm saying? They won't care. Right. So the one thing that we have to do is we do the insurance with State Farm, Todd Brown and Broken Arrow. He's fabulous. Stonebrook Investment Group owns the policy. And there's additional insured. An additional insured will be our client. Right. Additional insured will be our banker. So if there is a problem and the house has major issues, then we have filed on insurance. And then I have to, in my integrity, manage that process for them. Does that make sense?
Absolutely. Does that mean, though, that if the house burns down entirely, State Farm's going to cut a check and that your name, it goes to Stonebrook, or does it go to Stonebrook and the bank and the occupant of the property? How does that work in terms of actually cashing that check so you can pay out a contractor to fix the house?
Stonebrook and the bank.
Okay.
So we would sign it over, and then we've replaced 2 roofs like that. But the cost of insurance and then my price point is such that the cost of roofing, if there's a 1% of the value of the house,
deductible,
right? And then the cost of a roof doesn't make it worth the while. I have sat down with the clients and said, okay, here's the deal. Your deductible is $1,300. We looked at a lot of roofers. The average roof is, $4,500. And because they've depreciated it, there's a hailstorm. Really, you don't want your payment because we pass it on, right? We don't want your payment to go up to file a claim. So why don't we just say, let's put a new roof on for you? And if they're struggling, this is the integrity part. I want them to stay. I want them to be happy. Often, they'll just put a new roof on because they're going to have to be out of pocket, $2,800, $3,000 anyways on a $4,500 roof. One of the things we've done is we've lent clients that $1,500
and just wrap it in
under your payment. No interest. We want to help you.
Right.
That makes sense.
Yeah.
The clients love that. So do we advertise? Not at all. I get calls weekly. Mr. Brook, you got something else? My brother's moving into town. I'd love to get a house. So good name is above all.
So let me ask you, in a 30-year, in a conventional mortgage, a 30-year fixed rate through Fannie or Freddie or others, Ginnie Mae or whoever else, there's a due on sale clause. And some of our clients ask us about this because if they deed the property from their personal name into an LLC, it could theoretically trigger the due on sale clause because that's a trade. It doesn't, I think generally speaking, as long as you're paying your mortgage payments, the servicer does not care. They're not going to ever do it. I've never heard of it happening. And I've done this for a number of my properties specifically, but is there an issue if you have a 30-year mortgage and you do a contract for deed? Is there an issue where the mortgage company could actually call that due on sale clause and try to make you pay off the entirety of the note?
Yeah. I have tons of experience with this. So rather than ramble on, let me tell you efficiently, and then you go to details as you need. Okay. Over time, I've experimented deeding 30-year notes that were traditional rentals.
Right.
I just deeded into my personal name to see. I would just see,
Sure.
I'm in control of the LLC. I'm in control of my name.
Absolutely.
And, Wells Fargo called me on it. I remember I had 6 loans back in 2004 with them, and they sent me a letter saying, "Oh, no, you got to deed it back." Okay, wow. So I deeded into the LLC, so I had to put it back. In the contract for deed world, remember, we are not deeding the property over. Again, used car lot. Once they satisfy the contract, they get the deed. So if this client wants their attorney or the attorney that closed to file the contract for deed at the courthouse to cloud the title, it has not, as of yet, over all of these years, caused a due on sale clause. Because if my banker looks on the title, they're not seeing a title change; they're just seeing something filed. Does that help clarify?
Absolutely.
I will say I have preferred, though, over time to work like as you do with security. I work with Mabry Bank locally in our longtime bank, fabulous down there. And they understand what I'm doing.
Right.
And so they've never asked for any kind of clarification if I need to peel the house off or file the contract for deed to give our clients comfort or not. So there's loans on there. I don't ever really have that issue because it's all disclosed and it's all upfront.
Sure. I'll also say, just as a quick plug, whether Mabry Security or any other bank, it's worth having a great banking relationship.
Oh, yeah.
And it's worth not worrying so much about interest rates and going, oh, this person over here is going to give me 25 basis points less or lower, whatever it is. Like, just stick with a banker that knows your business, knows your model, and you are loyal to them, to that banker. He or she will repay you with understanding what you're doing and why you're doing it and everything else. It's so
okay, I'm a movie guy. I got a quote for you. You got this?
Yeah.
Do you remember that Leonardo DiCaprio movie, Catch Me If You Can?
Sure.
Great scene where his dad is in trouble and he pretends to be the limousine driver, pulls up, opens the door up, and then his dad walks out and says, "Watch the president of the Bank of New York greet your father." And he's enamored with his dad. And his dad walks in and sits down and says, "I just have a little tax issue. I just need, 50 grand to tide me over." And the banker says, "Yeah, but we don't know you."
Right.
That had a huge impact on me. Right. Because that's what you're saying is exactly right. Your security in your instance and Mabry with me, if they know you, they understand what you're doing. Don't ever go ask for money when you need it. Ask way in advance.
Right.
Prove your mettle. And so when times are tough, that's the relationship that's the most important in my mind. So I agree.
I mean, because the banker has to, in essence, go back to a risk committee or somebody higher up and say, this is the person, this is their history with us, this is their repayment history, this is their cash flow, this is all these things. Are we willing to extend ourselves a little bit to a greater degree to help this person out of the situation, or help this person, in your case, what you just said, before the situation actually comes to a head? And that longevity and that experience together is worth its weight in gold. So we have a lot of banking relationships. We deal with a bunch of different banks. We had Scott Reeves on here. He does a ton of our lending with us, and, build one or two or three. I mean, I think it's worthwhile having a bunch of people that are in your network that will lend to you, that have your personal financials, that understand your business, but build the relationship and don't go, looking around for the best rate. You can ask for a better rate. There's also, in a loan, you can extend the term. You can ask for, rate reductions. You can ask for, prepayment penalty waivers. You can do a whole bunch of stuff. There's amortization schedules, et cetera. There's many parts of a loan. You can ask for various things, and bankers are willing to concede. I'm not saying don't negotiate if you have, a bunch of bankers that are fighting for your business, but I am saying, establish a relationship of trust and mutual understanding, and it'll be better for everybody. I want to talk for a moment. You mentioned moving too quickly. You bought your first fourplex, you established a brokerage, you were buying real estate for yourself, and you moved too quickly. What do you say to people so often? And I'm 38 years old. We're talking here in 2022. I'm 38. I am a millennial. We want to move quickly. We want to be billionaires immediately because we saw Zuckerberg do it and we saw Sergey with Google do it. And we recognize that's a possibility in our world. We want to move quickly. We want to be really fabulously rich early on. What do you say to people that want, they haven't taken their first step yet, or maybe they've taken their first step and, they need to crawl before they walk, so to speak? How do you counsel people to avoid making the mistakes of moving too quickly like you did? Yeah,
I think mentoring is huge. And I've often dreamed, because I've enjoyed Robert Kiyosaki so much and Rich Dad Poor Dad, that I would wish he would have a panel for some of his, not as famous students, right? For the mistakes they've made. And that would be me. I would love to be on that panel, because he said something that I took completely wrong. And if those who know Rich Dad Poor Dad, they say your residence, your house is not an asset. Okay. So I made the mistake of misinterpreting that. When I bought my first fourplex, remember in the late 90s, and I talked to you, I leveraged my residence. I'm not saying that's the most horrible thing to do, but I leveraged my residence to put a down payment on a 20% down payment on a 30-year fixed conforming loan. So I leveraged my residence. The problem is that leverage grew on my residence, and it did not create cash. So I love leverage. investment property that pays for it.
On cash flowing properties.
I get that.
Right.
So to those that are asking how to be careful, my mistake was I didn't understand when Robert Kiyosaki was talking about your house is not an asset. He was living in a car and then an apartment with his wife, Kim, when he got started. So his first mortgages were not for where he lived. His first mortgages were for a rental property. And then he was in an apartment. So he got into a lot of debt that paid for itself with rental income. I got into debt where I lived. So it took me a long time. And that's great when asset prices are going up. When asset prices are going up, when the tide rises, all boats rise. Okay. But as Warren Buffett says, when the tide goes out, you learn who's not wearing a swimming suit, right? And so in 2008, that wasn't like where we're at now. That was uniquely banking, uniquely real estate focused. And that balloon popped hard and fast.
Right.
And then all of a sudden there was no liquidity.
Right.
I had more debt on my house than I could handle. So I needed to get a day job. If I had a paid off house or lived in an apartment, then it'd be no big deal. I could have just dealt with over here. So mentoring would have probably taught me more the big picture with my personal balance sheet, my personal cash flow, how things relate. The other side on my fake Robert Kiyosaki panel would be, I always think of Susie Orman, right? Personal financial coach as high school and Dave Ramsey as college. These are good plans. Like you got to go through high school and college to get to real life. But I bypassed them and went right to Kiyosaki, entrepreneurial world,
right?
Banking, buy no money down, leverage, woo. But then again, we've had a secular 40-year unbelievable bull market, if you will, in the bond market and the equities in the world. And I think we're heading to some really difficult times as things get redefined. So millennials, right? Look at your personal balance sheet. Look at your dry powder of cash. And diversifying, that can be debated. That's a future podcast, right? I personally think you have to be really good at something.
Right.
You got to go all in at something, but you need dry powder. So I would have cash, and then I would practice on paper, and then I would find somebody that has gray hair, and I would follow them around, and I would watch some deals beginning to end, and I would look for the negative, not just the positive. I don't mean being optimistic versus being pessimistic. I just mean reality. Just get to reality. What do you hate about this? What do you love about it? And you need truth.
Right.
And I think you'll avoid a ton by just talking to some gray-haired folks, if you will. So
it's funny you mentioned the Kiyosaki thing, because I bought my first rental property in 2014 in Boulder, Colorado with my sister at the time. So I'd signed on a bunch of different notes. We bought our first buy. I probably had 10 properties or 12 properties before I ever bought a primary residence. So buying a house that I was in Dubai, I was renting there, whatever. But then I finally bought my primary residence. It was a unique experience. And I had owned all these properties. My wife had not had any properties. So her signing a note on our primary residence was like a first time thing. For me, it was like, yeah, cool. I understand how this works.
Add it to the list. Yeah.
Add it to the list. It was fun. Let's switch a little bit. Who are some colleagues in the industry that you really respect that some of our viewers should know or follow or read? Interesting. And are you talking local colleagues, Tulsa? Anything. I'd love local colleagues. Anybody international. Yeah. Talk Robert Kiyosaki. Talk to a bunch of people, that are famous. Anybody. Who are you? Yeah. What podcasts are you listening to? What books are you reading that people should know about? I'm really kind of a macro nerd. Mm-hmm. So I'm at a place where we remember our, grandparents that survived the Great Depression. So, wow, we find these $10,000 wads of cash in the attic, cans out in the backyard. I have a little bit of that because the banking crisis was really rough for me. Yeah. So what I've done is I've kind of built this to be really strong. So I'm at a place that's really strong
but I'm paying attention to some macro things right now. So George Gammon, the rebel capitalist, is somebody that I don't know him personally, but I just think we would be buddies. Like I would hang out with this guy. So I love Ken, George Gammon, these guys that are kind of in that rich dad clientele. I struggle with some major media. I feel like there's so much spin in the world on so many subjects that's why I'm a hard asset guy. I don't mind leverage because it's against a hard asset in real estate. But inflation, supply chain, energy, all of this stuff makes me cynical when CNBC says it's all good, it's all good. The truth is, though, life goes on. So it's not like we stop, we don't give up, we just pivot. So that's why I like real estate. So Keyrenter will rent a property. Whether it's this price or this price, everybody has to live someplace. So we make decisions accordingly, right? So my mentors, the sources you're asking me about of who I like to listen to, tend to be a little bit more macro-minded. I will watch Bloomberg before I'll watch CNBC. I love George Gammon. I love Danielle DiMartino Booth. I kind of go down that path. And then locally, I'm a little quiet with my business right now because I'm just focused on managing what I have. Saw you guys at the tax lien sale. I love that. Or the tax resale. You know what I'm talking about.
Yeah.
Across the room, I said, I want to be in that group next year. I love it. So I'm really looking for where are we going to pivot, watching prices closely, wanting to do more properties with Keyrenter. And so does that answer the question?
Yeah, absolutely. I love it. We've been talking with Brook Reutter, Stonebrook Holdings. He does contract for deeds and also some just general traditional, I should say, rentals that we manage. So we really appreciate it. Brook, where can people find you if they want to learn more? If they want to get a contract for deed that you've worked so hard to produce over the last 25 years, where can they find you? Where can they learn more if they want you to do a little bit of mentoring for them?
Yeah, I would probably start with just my email. I don't have any social media focused on Stonebrook Investment Group is the entity. But my email, brookreutter@gmail.com. So BROOKREUTTER@gmail.com is a great way to reach me. I'm on LinkedIn, but that would be a day job. So not talking day job here, but that's fine. I can be reached in. Stonebrook Investment Group is linked with me on LinkedIn as well. So reach out. And I have both sought and given mentorship along these lines. So happy to help.
Super important. Brook, thank you for being on the podcast today. Learned a lot. I really appreciate it.
Yeah, you got it. Thanks, Matt.
Take care. Bye.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.